All right, everybody. Um, this is Dr. William Jones coming to you from the offices of the Future Millionaire Investor Alliance. Wanted to talk to you today about why not to use indicators. I am not a big fan of indicators for one very simple reason. It takes your mind, your eyes, and your brain off of what the most important thing is, and that's viewing the charts and pricing what they're telling you. Indicators can confirm, so I don't have a problem with using one as a confirmation. But just having an abundance of indicators on your chart where it then starts to look like artwork is probably not the best thing to do. Not saying that they don't have their place. I'm just saying the overabundance of them can cause you to have, for lack of a better term, it can make you second guess yourself for no reason. And let me tell you why. Price tells you everything you want to see and know when it comes to trading the markets. You don't have to second guess it, think about it, and I'll give you a prime example of that. If price is making lower lows and lower highs on a larger time frame, how do I know if it's making lower lows and lower highs on the larger time frame? Well, this is how you know, and I'll show you here. You can always look at the bottoms and the tops, okay? Look at the extreme bottoms and the tops. That's where they are right now. And you can see how price will then retrace. See that top right there. Okay, then you can go down to a smaller time frame and look. And the small time frame will probably look like it's trying to go up, which it does right here. Looks like it's trying to go up. When it fails, 9 times out of 10, it's going to go in the direction of that larger time frame. And that's where the 2B comes in. 2B comes in because it's nothing more than a failed breakout. Tried to go up in this particular case and couldn't. Everybody sees where it's trying to go up here. Falls back down. The larger time frame was telling you that it's lower lows and lower highs. This tells you that it's higher highs and higher lows. But when it comes back down and gives you the confirmed 2B, meaning it closes below the bar that broke the high, which is here. Okay, it closes below that bar, which is in here somewhere. That is your 2B, not the retest. That is just your confirmed 2B. This right here is just your confirmed 2B. So I can enter the trade with a certain amount of confidence, knowing that the trade will go just where I think it's going to go, which is down. Okay, I would not suggest to anybody to enter into. If you can trade 10 lots, I would trade 1. Because if you trade 10 and it happens to do something like it did this morning on me, and I'll give you a perfect example. I thought it was going up. Okay, I thought it was going up because price, again, on this time frame, was making higher highs here. This is a higher high. And higher lows. This is a higher low. So it's making higher highs and higher lows. Okay. So because it was making higher highs and higher lows, I'm thinking, hey, it's safe for me to go up. And it gives me the confirmation here showing me the 2B. Here, wait, you get in. It went up a little bit. And then guess what? Tanked. It tanked on me. And when it tanked on me, I had a problem, except for the fact that I didn't get in all that I could get in. I got in on a small portion because one of the things that I've always said, you have to assume that you're going to be wrong and enter on 2 or 3 times at least. Well, one of my business partners, he and I had a discussion, and we were talking about, ways to not get in as much as you would get in normally. And as it's going down, as long as you can see the trend is still in your favor, using the math equation, basically, you'd add more and more to it, and then when it comes in your favor, it doesn't have to go in your favor as much in order for you to make money, which is exactly what happened to me today. But my point is, you don't ever want to enter into a trade all that you can. If you can trade 10 lots, you don't want to trade 10 lots on the outset, because it can cause you a very bad problem in case you're wrong. If you lose on 1 or 2. If you win on 3 or 4. And that's really just, that's all I'm saying. But you don't need indicators for that. Indicators you can use as confirmation, but you don't need indicators for any other reason. And that being said, that's why I don't use indicators, because price tells you all that you need to know. Indicator is nothing more than a formula based on price anyway. So if you use an indicator, it's diluting the price or the significance of price. So that's why I say don't use indicators unless you use it as a confirmation tool. Like if you want to say, okay, which way is the trend? I want to trade in the direction of the trend. Okay, that's beautiful. We'll trade in the direction of the trend. Get the trade, take it, and bam, we'll make money. However, if you use the indicator as a reason to take a trade, as you've seen in previous classes that we've had, the indicator can lie. Price cannot, but the indicator can. So those are things that I just want you to be aware of, things that I want you to think about, because you only need price to tell you what all you need to know. Only thing you need to trade, there's only a certain amount of things to trading and investing, and let me tell you what they are right here. This is why you don't need indicators. All you need to know is how to know where higher lows, higher highs, lower lows, lower highs, 2B retest, 2Bs, and that's it. You don't need to know anything else about the stock market to be consistent in it. If you were to know that and that only, you can make all the money you want to make if you get the discipline to wait on those things to happen in a certain way. And those are the things that we talk about every day in the trade room. So that's it for me. Today, I'm not going to belabor the point. If anybody has any questions, please let me know. Otherwise, we're going to go ahead and end the session. So I'll wait a minute to see if there are any questions.